Well, I think in a general sense, you're right. When oil prices are down for the economy broadly, it is good. But here's what we know. Some of the data that we've seen tells us that all the money that people save at the pump is not necessarily going out into the economy. Some of it's going to pay down personal debt. Some of it's actually going into personal savings. So we see a little bit of an impact, but we also have concerns about the dollar going up. And when the dollar continues to go up at the rate that it's going up, it's no wonder that oil prices keep dropping. When you add that to the supply glut, it's going to be very difficult for that to change. So those are causing all sorts of problems in the market. And then when you add to that the things that are going on at the Fed, when's the next interest rate, or when's the first interest rate going to happen, first interest rate rise? You've got this battle of influences of different data, and I think traders just really don't know which way to move on this.
Yeah, I would agree with that, and I think Goldman Sachs had it perfectly today, that what really created this was a very, very cold winter that pushed up demand, almost like a sugar rush, but also the fact that structurally oil is so much more expensive down the road, that there was demand for hoarding. There was a reward for hoarding. When that runs its course, and I think it runs its course in the next 45 or 60 days, we could see much lower prices briefly. There are about a half a dozen catalysts. You've talked about the dollar. The guests have talked about the dollar. The dollar hurts oil demand in some emerging markets. We're in the shoulder season right now, so we don't have winter demand, and it's much too soon for the driving season. And refiners, people were talking about a strike. I thought it was a very specious reason for gasoline prices to go up and drag crude with them, and that looks like it'll be settled. So most everything points lower. I think 5 months from now it'll be clear up, but the next 5 months look very challenging.
We're waiting until next year because, there's a difference between what the Fed wants to do and what we think they will be able to do. The Fed wants to raise rates this year. I mean, I take the vice chair at his word. Last week he said, plain and simple, we want to raise rates this year. But we don't know what will happen between now and then. And that is the nature of a data-dependent Fed. If you go to data dependency only, you can't say what happens between now and then.
What data is holding him back?
So the price data, core PCE, which is important, they don't need it to be at their 2% goal. Janet Yellen has said that. But the problem is right now it's moving further away from goal. And also the lack of nominal pickup in nominal wage growth. We know that's coming as the unemployment rate keeps getting lower. We know we're going to get tight labor markets soon enough to boost wage growth. I think it's the prices that are a real problem. And what we have right now is two factions on the Fed fighting against each other. One faction is willing to put faith in the outlook. Right. And then there's the other faction that wants to see proof in the data.